Most people dream of investing, building wealth, creating a better future. But you know what stops them? Not lack of money, but not knowing where to start. And because of that, they wait. They wait for the perfect moment. They wait to feel ready. And that waiting? That's the biggest financial mistake anyone can make. Today, I'm going to help you break that cycle. I'll show you how to start investing the right way, even if you're a complete beginner. And just a quick note before we dive in. I'm not a financial expert. I'm learning through real-life experience, consistent research, and studying every day. So think of this video not as advice from a guru, but as guidance from someone walking this path alongside you, step by step, just like you are. Ready? Let's build your investing foundation, today. Section 1, Why Investing Matters. Hello, investors. If you've ever wondered why you should start investing, or felt intimidated by the investment world, this video is for you. Today, we're breaking everything down in a simple way so you can turn your money into a powerful tool to build the future you dream of. The transformative power of investing. 1. Where does your money go? Picture this: you work hard, get your paycheck, pay your bills, and save whatever is left in your savings account. Sounds safe, right? But here's the truth most people never talk about: while your money sits in a savings account, inflation is quietly eating away at it. Key fact. Over the last 50 years, the US market has returned an average of around 10% per year, while inflation averaged about 3.8%. Leaving money sitting still is like trying to fill a bucket with a hole in it. 2. Saving versus investing, they are not the same. Let's clear up one big misconception: saving and investing are not the same thing. Saving is like riding a bicycle. Safe and predictable. Great for the short term. Easy access to your money. Low returns. Investing is like launching a rocket. Higher potential speed and growth. Requires planning. Best for the long term. Protects you against inflation. The 6 pillars of smart investing. 1. Your shield against inflation. Remember inflation? Investing builds a shield that helps protect your purchasing power. While prices rise, your investments have the potential to rise faster. 2. The magic of compound interest. Albert Einstein called compound interest the 8th wonder of the world, and he wasn't kidding. It's when your money starts making more money for you. Example. If you invest $200 a month starting at age 25, you could have over $1 million by age 65, assuming a 10% average return. The secret? Start early and stay consistent. 3. Passive income, money working for you. In a world obsessed with side hustles, investing offers real passive income. Bonds, dividends, and index funds can create income streams, without extra hours of work. 4. A stress-free retirement. Did you know 64% of Americans don't feel prepared for retirement? Let's change that. Quick Retirement Account Guide. 401k, pre-tax contributions plus possible employer match. Roth IRA, pay taxes now, withdraw tax-free later. Traditional IRA, tax deduction now, taxes when withdrawing. 5. Smart tax advantages. The US government literally gives you tax benefits for investing. Using tax-advantaged accounts can dramatically boost your wealth over time. 6. Build a family legacy. Investing isn't just about you, it's about creating opportunities for future generations, whether it's funding education or building generational wealth. What to know before you start. 1. Understand your risk profile. Before investing even $1, ask yourself, how much risk am I comfortable with? Your answer shapes your strategy. 2. Build a strong financial base. Investing without a foundation is like building a house on sand. Pre-investment checklist. High-interest debt paid down. Emergency fund, 3 to 6 months. Clear financial goals. Budget under control. Your first practical steps. 1. Open your investment account. Starting is easier than ever. Platforms like Fidelity, Vanguard, and Charles Schwab make the process simple and offer support for beginners. 2. Choose your path. Which style fits you best? Hands-off, robo-advisors like Betterment. Guided, professional financial advisors. Hands-on, self-directed investing. Common obstacles, and how to beat them. I don't have enough money. Truth, you can start with just a few dollars, even $50. It's too complicated. Truth, like any skill, investing becomes easier with practice and education. Action plan for beginners. Your 6-month investor roadmap. 1. Month 1, learn basics plus open account. 2. Months 2 to 3, start with small investments. 3. Months 4 to 6, diversify plus keep learning. Useful resources. SEC.gov, official regulatory info. Investopedia.com, Learning Center. Free retirement calculators online. Final message, your future starts today. The best time to start investing was yesterday. The second best time is right now. Every dollar you invest today is a step toward the financial freedom you deserve. Section 2, First Steps Before Investing. 1. Build your financial foundation. Before you build a skyscraper of wealth, you need solid foundations. Imagine trying to build a house on quicksand, it just doesn't work. The same applies to your investments. Your financial safety checklist. Emergency fund, 3 to 6 months of essential expenses. High-interest debt, pay off credit cards first. Realistic budget, invest without sacrificing basic needs. A great tool to organize your finances is Mint or an app, You Need a Budget. Both offer free trials so you can test before committing. 2. Define your financial why. Investing without goals is like sailing without a destination. Every dollar should have a purpose. Common U.S. investment goals. Retirement, a 401k with employer match is gold, grab that free money. Education, 529 plans for your kids' college. Buying a home, tax-advantaged or standard brokerage for the down payment. Financial freedom, strategic mix of accounts and assets. 3. The power of starting small. You don't need to be rich to start investing, that's one of the biggest myths. Example growth over 30 years, 8% annual return. $50 per month, approximately $113,000. $100 per month, approximately $226,000. Platforms like Betterment and Wealthfront are great for beginners, like having a financial personal trainer. 4. Automate to win. Consistency is the real superpower in investing, and automation makes it effortless. Smart Automation Guide. A. Link your bank account to your brokerage. B. Set recurring deposits, bi-weekly/monthly. C. Let it grow silently in the background. Try automating the day after payday, you pay yourself first. 5. Strategic patience. Here's the counterintuitive truth, the less you touch your investments, the better they perform. Why long-term wins? Markets historically recover and grow. Time in the market greater than timing the market. Less stress equals better financial decisions. Think of your investments like a tree, growth takes time. Helpful tools. Apps. Mint, budgeting and big picture view. Personal Capital, investment tracking. Fidelity/Robinhood, beginner investing. Morningstar, fund and stock research. Free resources. Fidelity retirement calculators. Official SEC investing courses. Paper trading simulators. 7-day starter challenge. This week, I challenge you to 1. Days 1 to 2, calculate your emergency fund. 2. Days 3 to 4, review 401k options at work. 3. Days 5 to 6, set up a budget in Mint. 4. Day 7, open your brokerage account, even if you don't deposit yet. What's your biggest challenge when starting? Share below, let's learn and grow together. Every journey starts with a single step. Your future self will thank you for starting today, the best time is now. Quick reminder. I'm not a financial advisor or investment expert. I'm simply sharing what I'm learning through experience, research, and reading. Always do your own research before making financial decisions. Section 3, Where Beginners Should Invest. Before choosing where to invest, you need to know where you want to go. Think of your financial goals like destinations in a GPS, each one needs a different route. The 3 pillars of smart planning. 1. Your current situation. Quick exercise, add up your monthly expenses and subtract that from your income. That leftover amount is your fuel for investing. 2. Your time horizon. Short term, 1 to 5 years buying a home, car, travel. Medium term, 5 to 10 years kids college, starting a business. Long term, 10 plus years retirement, financial freedom. 3. Your risk roller coaster tolerance. If your investments drop 20% tomorrow, would you? A. Panic and sell. B. Stay calm and hold. C. Buy more. Your answer says a lot about your investing style. The U.S. investment account supermarket. Each goal needs the right container, like picking the right packaging at the grocery store. 401k, employer-matched free money. If your job offers matching contributions, that's basically free money. Always try to contribute up to the match. IRA, your personal retirement vault. Traditional IRA, pay taxes later, good if you earn more now. Roth IRA, pay taxes now, great for young investors expecting higher future income. 529 plan, college growth engine. Not just for Ivy League, can be used for trade schools, grad school, and transferable to family. Taxable brokerage account. For goals outside retirement, total flexibility, but pay taxes on gains. The perfect investment recipe. Now the fun part, building your portfolio. Think of it like making a pizza, each ingredient has a role. Your investment, pizza. Stocks, cheese 60 to 80%, growth. Bonds, sauce 20 to 40%, stability. Cash, seasoning 5 to 10%, emergency reserve. The longer your time horizon, the more cheese you can add. Quick quiz. More than 10 years until retirement. More stocks. Need money within 2 years. More bonds. Hate volatility. Approximately 50-50th split. The 3 levels of diversification. It's not enough to have one pizza, you need different flavors. Level 1, asset classes. Stocks, bonds, cash. Level 2, economic sectors. Tech, healthcare, energy, consumer goods. Level 3, geography. US, Europe, Asia. Total market ETFs are like a buffet, a little of everything without thinking. Your annual portfolio checkup. Your portfolio needs maintenance like a car, schedule a yearly rebalance. Time to rebalance if allocation shifts more than approximately 5%. Major life changes. Market swings heavily. It's like pruning a tree, trim what's grown too much, strengthen what needs support. DIY versus financial advisor. Do it yourself. Total control. Low cost. Learn fast. Time consuming. Emotional decisions. Mistakes can be expensive. Using an advisor. Professional guidance. Full planning, taxes, estate, retirement. Helps control emotions. Customized strategy. Higher cost. Requires trust and research. Not all advisors are equal. What it costs to start. Good news, you can start investing for the price of a coffee. Typical minimums. Robo-advisors, from $1, Betterment, Wealthfront. ETFs, $50 to $200 per share, Vanguard, iShares. Mutual funds, $1,000 to $3,000. Human advisors, usually $5,000 plus. Remember, it's not about how much you start with, it's about starting. 15-minute action challenge. This week, spend just 15 minutes to 1. List your top 3 financial goals. 2. Research an IRA account at Fidelity or Vanguard. 3. Calculate how much you can invest monthly. Every millionaire started with their first investment. Yours could be today. Section 4, Smart Beginner Strategy. Breaking the ice. Investing can feel intimidating, like it's only for Wall Street pros shouting at screens or people who understand crazy charts and formulas. But here's the truth. Investing is one of the most important tools for anyone in the US who wants to build wealth, retire comfortably, buy a home, or support their kids' education. And the best part? You don't need to be an expert to start. Let's break this down together, step by step. Before you invest, know your risk comfort zone. Before you put your first dollar in the market, ask yourself one question. How much risk am I comfortable taking? Some investments feel like sailing on a calm lake. Others? Like surfing massive waves. You don't want to jump into the ocean without knowing whether you can swim. Think about time, too. If you need your money back in 1 to 2 years, stocks may not be ideal. But if your goals are 5, 10, even 20 years away, then you have time to ride out market ups and downs. Knowing yourself is the first, and smartest, investment you'll ever make. Your beginner-friendly investment toolkit. 6 simple starting points, without complexity. 1. The free money machine, employer 401k. If your employer offers a 401k, especially with matching, start there. Not contributing means saying no to free money. Traditional 401k, tax savings now. Roth 401k, tax-free withdrawals later. Pro tip, target date funds automate your allocation as you age, perfect for beginners. 2. The set it and forget it choice, index mutual funds. Index funds track the market, like the S&P 500, instead of trying to beat it. Lower fees equals more money compounding for you over time. Simple and powerful. 3. The flexible all-star, ETFs. Think of ETFs like mutual funds, but easier to trade and often cheaper. Many brokers let you buy fractional shares, meaning you can start with just a few dollars. 4. The high-risk, high-reward option, individual stocks. Buying single company shares offers big upside, and big risk. Ask yourself, do I understand this business? And be ready to hold for years, not days. If volatility stresses you out, stick to funds. 5. Effortless growth for short-term goals, high-yield savings accounts. Perfect for emergency funds or money you'll need soon. Higher interest. Easy access. No stress. 6. Safe and predictable, certificates of deposit, CDs. With CDs, you lend your money to a bank for a set period. Higher interest than savings, but penalties if you withdraw early. FDIC insured up to $250,000. Why start now? You might wonder, do I really need to start today? Short answer, yes. Inflation quietly eats your money over time. If cash sits in a low-interest checking account, it loses buying power every year. For short-term goals, high-yield savings. For long-term goals, stocks and ETFs historically build wealth. Your 5-point pre-investment checklist. Before pressing buy, check this. 1. Risk tolerance. Can you handle ups and downs? 2. Clear goals. House in 5 years, retirement in 30, etc. 3. Investor style. Passive, index funds, versus active, stock picking. 4. Management style. DIY brokerage versus robo-advisor versus human advisor. 5. Tax strategy. 401k and IRA first, taxable account later. Plan smart, invest smarter. Important: I'm not a financial advisor, I'm sharing what I'm learning through experience, research, and reading. Always do your own research before making investment decisions. Starting my investing journey today. Let's grow wealth together, one step at a time. Section 5. Risk management. Imagine investing like sailing across the ocean. Some days the water is calm and the sky is clear. Other days, storms, huge waves, uncertainty. Risk is like the weather, it's always there. The goal isn't to avoid sailing. The goal is to learn how to read the map, build a strong boat, and adjust your sails when the wind changes. Today, you're learning how to become the captain of your financial ship, managing risk so you can reach your destination, long-term wealth. Risk demystified: it's not about elimination, it's about control. So, what is investment risk management? In simple terms, it's the intentional effort to reduce unnecessary risk in your portfolio. And here's a truth every beginner needs to hear. You will never eliminate risk completely, not even with so-called safe investments. Even savings accounts lose value to inflation over time. The idea isn't to avoid risk, it's to control the kind of risk that can derail your financial goals. Just like big companies manage risks to survive, you can do the same with your money. And don't worry, it doesn't have to be complicated. There are simple strategies anyone can start using today. Your Risk Management Toolkit, for essential strategies. Let's open your Risk Defense Toolkit. These are the 4 most powerful tools to protect your money. 1. The foundation: asset allocation and diversification. Think of this as your base strategy. Asset allocation equals the mix of investments in your portfolio. Stocks, more volatile; bonds, more stable; and cash, very stable but grows slowly. It's like having shock absorbers on your car, they soften the bumps on the road. Diversification equals don't put all your eggs in one basket. In stocks, mix different industries, company sizes, and countries. In bonds, mix government, corporate, and different maturities. If one market crashes, your entire portfolio doesn't go down with it. It's protection, and smart investors never skip this step. 2. Adjusting your stock/bond mix, your personal risk dial. Your risk tolerance is not fixed, it evolves with your life. Maybe you're 35 and invested aggressively, 85% stocks, 15% bonds. Sounds great for long-term growth, unless the market swings make you panic and lose sleep. And there's no shame in adjusting. Changing to 70% stocks and 30% bonds can reduce big swings and give you peace of mind. Remember, the best investment strategy isn't the one with the highest return. It's the one you can stick to consistently without panicking. 3. Hands-off strategy: let a pro, or a robot, take the wheel. Let's be honest, managing investments can be overwhelming. If you're risk-averse or prefer not to manage everything yourself, consider a financial advisor for personalized support, or a robo-advisor for automated, low-cost management. They help you stay calm during market turbulence and prevent emotional decisions, which are one of the biggest causes of losses for new investors. 4. The power of inaction: yes, doing nothing is a strategy. This one sounds strange, but it's crucial. Sometimes, the best move is no move. Your brain feels losses more strongly than gains, it's natural. But if you've built a diversified long-term portfolio, short-term news and market noise are just distractions. Don't panic. Don't react emotionally. Stay the course, because reacting to fear often locks in losses and causes you to miss the recovery. Being patient is not weakness, it's a superpower. Risk versus reward: finding your balance. In the end, successful investing is balancing risk and reward, in a way that fits you. Ask yourself, Does my portfolio keep me awake at night? If yes, something needs adjusting. Research shows that trying to time the market almost always fails. Investors who stay invested, even through rough markets, are far more likely to succeed. Great risk management isn't about beating the market. It's about knowing yourself, building a strategy that matches your life, and staying disciplined. Master this, and you won't just be investing. You'll be investing wisely. Section 6, Your Beginner Action Plan. You've learned what to invest in, and how to manage risk. Now it's time to bring everything together. This is the exciting part, building your personalized investment plan. Think of it like drawing your map. Every financial decision you make from here on should follow this guide. And the best part? You don't have to guess. We're going to build this step by step, together. Step 1, the foundation. Know where you stand today. Before building a skyscraper, you must inspect the foundation. Start with a clear picture of your current financial situation. Create a simple budget. How much comes in? How much goes out for essentials? What remains? That leftover amount is the fuel for your investments, but wait. Before you invest, do you have an emergency fund? Think of it as your financial life vest. Once that's secured, you can confidently decide how much to invest each month without stress. Step 2, your destination. Define your why and your when. A ship without a destination never arrives anywhere. So, why are you investing? Your reason becomes your guiding star. Are you saving for a house in 5 years? Your kids' college in 15? A peaceful retirement decades from now? Most goals fall into 3 categories. Security, protecting what you have. Income, generating cash today. Growth, building wealth for the future. Once you define your goals and timelines, your investment choices become clear. Step 3, your personal gauge, risk tolerance and time horizon. Now, let's talk about you. Your investing style comes from 2 things. 1. Emotional risk tolerance. Will market swings make you panic? If yes, you're more conservative. If not, you can handle more risk. 2. Time horizon. How long until you need the money? More time equals more flexibility and more risk tolerance. Less time equals play safer to protect your capital. Where these 2 meet determines your ideal investment mix. Step 4, picking your players. Choose your investments. With a strong foundation and clear direction, now it's time to choose your investment vehicles. For long-term goals like retirement. Stocks, ETFs, index funds. Inside 401k or IRA accounts if you live in the US. For medium-term goals like buying a home. Bonds. High-yield savings accounts. For education-focused goals. Consider a 529 plan. And remember, never put everything in one basket. Diversify your investments to build a resilient portfolio. Step 5, your rulebook. Create an investment policy statement, IPS. This step separates beginners from disciplined investors. An IPS is a simple document where you write down your goals, your risk tolerance, your asset allocation plan, when and why you buy, sell, or rebalance. Why do this? When markets get emotional, this document keeps you rational. It protects you from panic decisions and keeps you aligned with your long-term vision. Step 6, the maintenance, monitor, rebalance and stay consistent. Investing isn't set it and forget it. It's like a garden, it needs occasional care. Once or twice a year, review your portfolio and rebalance. If stocks rise too much and suddenly become 90% of your portfolio when your plan said 70%, you're taking more risk than intended. Rebalancing means selling a little of what grew too much and reallocating to what's underweight. It's a disciplined way to sell high, buy low, and stay aligned with your strategy. Final words of wisdom, your journey starts now. Before we wrap up, remember two powerful truths. 1. Don't hesitate to seek help. Financial advisors are like personal trainers for your money. Guidance builds confidence and clarity. 2. The best time to start was yesterday. The second best time is right now. Time is your greatest investing ally. The earlier you begin, the more compounding works in your favor. You don't need to be perfect, you just need to start. Take what you've learned, take your first step, and begin building the future you deserve. Friendly disclaimer, human and honest. And just a quick reminder, I'm not a financial advisor or investment professional. I'm learning as I go, through real-life experience, consistent research, and a lot of reading. Everything shared here is meant for educational purposes and personal growth, so always do your own research and make the decisions that are right for your situation. Investing isn't about perfection, it's about action. The biggest wealth builders in history didn't start with the most knowledge. They started with the courage to begin. And here's the truth, your future self is watching. And they will thank you for taking this first step today, not someday. If this video gave you clarity or confidence, make sure to like, subscribe, and turn on notifications. It truly helps this channel reach more people who need guidance on their financial journey. Now I want to hear from you. What's your biggest question or fear about investing right now? Drop it in the comments. I read every one and I'd love to help. Remember, everyone starts somewhere. What matters most is that you started. This is my wealth guide. Thanks for watching, and I'll see you in the next video.